Are you feeling the squeeze of sky-high housing costs? What if I told you that, brace yourself, a new report suggests the tide is turning? Backed by popular demand, BNZ Chief Economist Mike Jones is here once again. His latest Eco Pulse report might just save you thousands and put you on the fast track to financial freedom.
Financial freedom faster. Financial freedom faster.
This is New Zealand's fastest growing real estate and investment show. If you like making money rather than watching everyone else do it, hit that subscribe button and stay ahead of the pack. Mike has been crunching numbers for nearly 20 years, which is a very long time to be staring at spreadsheets. Mike, have housing prices actually become affordable, or is this just another cruel joke?
Yeah, hi Andrew. Have they become affordable? Probably not. Have they become more affordable than they were? I think we could say probably. As you point out, we've just put a report out basically assessing housing costs against the cost of renting, which is something we get asked about quite a bit. I mean, in short, on our numbers, and we just look at, I guess, the operational costs over the coming year, the stuff that we can see, housing costs generally are always above those of renting. But what we've seen just in the last 12 months is that gap has narrowed quite a bit. So renting is still roughly 25% of household income as far as costs go when you make a bunch of assumptions, as you can see in the report. To own a house has come back to about low 40s, largely because mortgage rates are coming down alongside pretty flat house prices. You've got a little bit of offset in there from those higher insurance rates and maintenance costs that we all know about, but overall that gap's narrowing. And look, that's something we think will play to the grain of what we're seeing at the moment. Was a little bit more demand for housing out there.
Yeah, well, let's talk about interest rates for a second. So OCR has recently dropped from 4.25 to 3.75. There's a lot of commentary that this neutral rate is around 3%. Now, should we be seeing and encouraging faster drops? Even though they've increased the pace, do they need to increase the pace even more to get closer to that 3% rate?
Oh, we don't think so. I mean, we've had, as you said, 3 50-point cuts in a row now. We're at 375. Seems like the best guess for our neutral rate's about 3. So I think the closer that we get to that neutral rate, the more the bank's going to park that bazooka, the 50-point cuts, and go for more of the sort of the scalpel, a bit more fine-tuning, softly type approach. They've been pretty clear that they're going to cut again 25 points in April and May, maybe one more after that. So look, there's still clearly some downside for the official cash rate, and we think that means there's probably also some downside for particularly those shorter mortgage terms. So your 6 month, your 1 year, maybe a little bit on the 2 year as well. The Reserve Bank's been out there saying, look, they want those rates to keep coming down and that stimulus to get into the economy.
Yeah, so we're seeing some rates from some of the banks with 4.99 up to 5.19, 5.29. With the OCR continuing to drop slowly, are you happy to keep saying, look, interest rates will keep falling for the rest of the year?
I'm sure you could probably say to the end of the year. One thing that was interesting in the Reserve Bank's commentary and forecast was the fact that they previously had interest rates dropping continuously from now 2026 2027. It was a really slow and drawn out cycle, and what they've done is they've crunched all of that basically into this year, which seems like the more reasonable thing to do. That was what we were forecasting, is actually front loading, if you like, the pace of rate cuts, because there's clearly an argument to get them done earlier given where inflation is, given where the economy is. So I think we'll see that rate cutting cycle end this year. Just when is pretty hard to pick. Our expectation is, say, in the third quarter, and then a bit of a holding pattern from there while the bank assesses how the cuts they've given to date have propagated through the economy and what that means for the likes of housing, amongst other things. So yeah, it looks like from where we sit at the moment that it's really going to be a story just for this year.
A reminder, if you're ready to transform from novice to market expert in New Zealand real estate, hit that subscribe button and unlock the insider secrets to dominating the property scene. We have seen how interest rates going down has put pressure on house prices going up. Now, are you guys at BNZ seeing interest rates, if there's pressure for them to go lower, that it supports an increase in house prices, or more of the status quo where we were at?
I think it's a really interesting question, actually, because there's clearly a bit more demand out there, and we can see it in the official numbers. You can also see it in some of the anecdote, some of the softer numbers, things like open home attendance, auction, the numbers going to auction clearance rates, lending, all of that stuff is going up. So housing demand is clearly perking up, as you'd expect when you get these big drops in interest rates, and there wasn't, let's be honest, much happening over the past couple of years. The whole market was pretty well frozen up. So it is thawing out. The question is, well, does that demand wear off the inventory that's in the market? Because at the moment, you'd probably still say the housing market and the rental market are oversupplied. This is something we talked a little bit about in that report, which is there's a lot more supply coming through. Inventory is still relatively high. So if you get more housing demand, does it wear off that inventory? And kind of has to if you think prices are going up. So look, cutting to the chase, our expectation is that we'll see a bit of a bump in house prices. We've still got a forecast on the board for this year of about 7% lift in house prices, and that says that inventory gets worn down as demand picks up. But it's an area of uncertainty because we probably hadn't expected unsold inventory or listings to be as strong as they have.
Yeah, well, let's talk about this rental vacancy issue. As a lot of places around the country have seen a big increase in vacancy. What are you attributing that to? And for how long are investors going to have this issue of finding good tenants and keeping them?
Yeah, it's been a big change in the market. I mean, we've obviously had quite a strong run for rents, and relatively low vacancy. It seems to have changed quite dramatically, probably in just the last 9 to 12 months. Figuring out why, I mean, we know a lot of the candidates. It's hard to know which weighting to apply on each. There's some combination of people putting houses that haven't sold in the real estate market into the rental market. There's obviously a bunch of New Zealand citizens that are leaving the country, potentially leaving behind their home, and that's going on the rental market. There's also some evidence that with tourism in New Zealand not having recovered all the way back to pre-COVID levels, that people are putting Airbnb type properties into the rental market, the longer term market as well. So all of that stuff's happening at the same time as the migration boom, the population boom in New Zealand has rapidly deflated. I mean, it's gone from the strongest population growth we've had in almost 80 years, 12 months ago, to now below average 0.9% in the last year. So all that stuff's happened at once, which has taken the steam out of that rental market. I think when we look ahead, the thing for us is that population growth from here probably stays below the growth in the dwelling supply, basically. So your sort of proxy for housing demand is growing at a slower rate than your proxy for supply. So it seems to me that pressure on rents to either not go up or even fall in some areas is probably going to stick around for a wee while, for most of this year.
A reminder, join our revolution of innovative New Zealand property investors by subscribing today. Get access to game-changing strategies and insider scoops that put you ahead of the curve. If you're buying for cash flow, the numbers are hard to make sense of. You really are banking on capital gains in a lot of areas at the moment. And I guess with the cost of living and the relatively lower levels of income per capita, people are choosing to live more people under the same roof, I guess, and that's impacting the vacancy as well.
Yeah, look, it may well be. And the other thing, of course, about looking at the rental market is that it's quite mixed by the regions. I mean, people like me tend to talk in sort of national averages.
Yeah.
But then you do actually experience some pretty mixed conditions around the regions as well. And clearly, at the moment, Wellington is right at the top in terms of that higher vacancy rate. Auckland's not too far behind. And then you've generally got parts of the South Island and some of the regions at the other end of the spectrum. So I think the market's also become, not just the rental market, but the housing markets become, more two-speed around the regions. I go down to the South Island now and then to present. I'm obviously Auckland based, and you talk about the weak housing market, and people will look at you kind of, well, where's this guy come from? Because house prices in Otago and Canterbury be going up for 12, 18 months. So it's quite a different market there than what it is, for example, in Wellington and Auckland.
Well, it's a good time to be a renter, if you can afford it, I guess, is with all these new regulations making with healthy homes and with options to choose from, it does keep the relative cost of renting quite low. And even though your figures show that the relative cost of buying versus renting is becoming easier to buy, it is still a lot more expensive buying and owning a property than renting.
Yeah, that's right. Certainly in terms of the sort of operational costs. So servicing a mortgage, paying the bills, paying insurance, paying rates, etc. It's generally always more expensive to buy. The thing you don't know, right? And I suppose the one drawback of these type of analysis is the biggest factor in all of it is, and you hinted at it, was what happens to the house prices, what happens to capital gains, because, and we do some analysis in the piece, which is to say, okay, it might cost you quite a bit more if you're thinking about buying a new home versus entering a tenancy. But if house prices were to rise 3 to 4%, well, that would offset all of those operational costs. It rises by more of your net benefiting, and by less you're out of pocket. So the biggest factor, if you like, in terms of the numbers, the financials, is something that's inherently uncertain, which is what happens to capital gains, what happens to house prices.
Yeah, and what's happening in Gisborne seems to be a huge, more than doubling of the vacancy rate.
Yeah, I'm very interested to hear. I need some boots on the ground in Gisborne, so if anyone's got some insights there, I'm all ears. But Gisborne has generally had a much tighter rental market than just about everywhere else. There's so little available in terms of listings, and you've seen the impacts on rents, where rents in Gisborne have risen at a much faster rate than just about everywhere else. So it seems like a little bit of that's normalizing. But yeah, I think I need a bit more local knowledge in terms of what's happening on the ground.
Yeah, I mean, looks like Wellington, Bay of Plenty, Gisborne, those areas, the vacancy rate has doubled over the last 12 months. So certainly some areas to watch. And if you're a contrarian investor, you want to be going in into areas that are having weakness, because that might correct back to the norm, I guess. What market segments are fueling the new lending at the moment?
Yeah, it's relatively broad based. I mean, we've seen some interesting changes in who's driving things over the past 12 months. Generally speaking, maybe going back a little bit further, first home buyers were very much at the forefront as investors pulled back. That's clearly started to change now. And the share of lending going to first home buyers has generally been trending down. Investors have been coming back into the market if interest rates have fallen, and there's been some changes in some of those tax policies around investors. So it does seem that investor participation is picking up, but there's a broad lift. The other thing that's probably driving the figures is the fact that we've got all these mortgage refis happening. We talked about it last time, that you've almost never had a higher run rate of refixing, and that's happening at the moment. I think as people are going through those, they're taking the opportunity to sort of have a look around and shift potentially. So that's part of the figures as well, just that natural extra bit of churn amongst existing owner occupiers. Variously, everyone's sort of in there, represented in the numbers.
Yeah, I saw a stat the other day about the top-ups being relatively low in the last 12 months, that people haven't been using their mortgages to top up like they used to, and that seems to, most people that are topping up, a lot of people that top up their mortgages are using that money to grow their businesses or make investments in their businesses, and because they haven't been doing that, that is having a lot of secondary impact. Are you guys seeing that at BNZ?
Yeah, look, I'm not sure what we're seeing at BNZ in terms of our specific numbers, but I mean, that would make sense, I think, to the extent that, confidence, I guess, is coming back into the economy with interest rates coming down, and we're probably, as we speak, in the throes of exiting recession. And so people feeling that they are a little bit more confident in the outlook and taking on, maybe a little bit more debt to expand and grow their business would probably be something you'd expect in that sort of economic environment that we're in now, which is one of recovery. I think confidence in the recovery is growing with each month that goes by. We're getting indicators that are saying more readily that things are improving. We're getting growth again.
Yeah, no, it is exciting to see the Reserve Bank make indication that the rates will keep coming down, and that gives people that do borrow money for stimulating GDP growth can take comfort and confidence to act on that. A reminder, stay ahead of the curve in the ever-evolving New Zealand property market. Subscribe today and enjoy exclusive content delivering unrivaled insights and winning strategies. How far has the Reserve Bank projected out? What are they indicating in 26, 27 what they're going to do?
I mean, not really. I think the way the Reserve Bank thinks about things, and that gets put in their projections, is look, let's just aim for what we think might be the neutral official cash rate, and then just leave it there. And what we probably know is, well, that's not going to happen. It's going to be either higher or lower, or there'll be a cycle one way or the other. But that's what they show in terms of the projection, is this sort of glide path down to neutral, down to that 3%. In theory, everything's then in equilibrium, right? You've got the OCR at neutral, you've got inflation around the midpoint of the target range, you've got the economy growing. So that, let's touch wood and say that sounds like a nice scenario. Let's all hope that plays out. So that's the guidance. But the other thing we know is, and we actually looked at these numbers, is there's a huge amount of uncertainty. If you look at what the number of times that the Reserve Bank says the word uncertainty in its statement, it was something like just under 80, which I think the previous statement was in the teens. So there's a set of projections, but there's obviously all the confidence intervals and stuff around it. And obviously we know, particularly the global picture at the moment is pretty volatile, changing day to day. But look, it's a much better picture than where we've come from, which was kind of high inflation, low growth. We seem to be moving in a positive direction on both fronts at the moment.
Yeah, well, I enjoyed reading through your Eco Pulse report that came out on the 27th February, and I do recommend people follow along on LinkedIn and subscribe to your guys' newsletter.
I think that's a nice plug. Thanks, Andrew. I'm pretty happy to leave things there, and definitely encourage people to have a read, and I'm always welcome to feedback as well. So let me know what you think about it, if you disagree, and if there's anything you are particularly interested in hearing, or have a go at researching that. So no, thanks again.
Yeah, leave some comments below and we'll see if we can answer them. Thanks again, Mike.
Thank you.
More cash, passive income coming fast. Make your money work for you. Live the dream that's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands.